Hi, I'm Robert Greaves, and this is The Point. This week I'm talking to Paul Kitney, adjunct professor, Chinese University of Hong Kong Business School. Let's move on from Hong Kong. What about China? What are the prospects this year for China?
Right, so China has a little bit more policy flexibility than most countries around the world because it has positive interest rates. Only this week we've just seen actually a large cut in the reserve rate requirement, which was a PBOC policy to stimulate the local economy. There's still some more scope for fiscal stimulus in China. They're still grappling with the ongoing trade dispute with the US. The so-called Phase 1 deal was not a reversal of tariffs. It was just a non-escalation.
Right.
The trade war, from an economic perspective, is unhelpful in the middle of a COVID-19 demand and supply side shock. It's actually just adding to the pain of all parties in that bilateral relationship, the United States and China, from an economic perspective. So they're still suffering from that. So we're seeing sort of likely to see an initial recovery where the stimulus kicks in post the deep decline in the first quarter and second quarter, probably in third to fourth quarter of this year. But then sort of anemic growth for most of 2021. And again, it really depends on, will there be a second or third wave? Will there be a vaccine? Or if not a vaccine, will there be an effective treatment to minimize the mortality rate?
China, Hong Kong, ASEAN. People are becoming more excited about ASEAN. What's your view this year?
I suppose a very popular theme at the moment is deglobalization.
Okay.
So where we're seeing production capacity shifting from China elsewhere. Now, some of that production capacity, for example, in the IT sector, is repatriation back to Taiwan of Taiwanese companies. We are seeing lower to mid-level manufacturing shifts to Vietnam and Cambodia, Vietnam being a major beneficiary. That actually had started well before COVID-19, but more likely to accelerate as a consequence. Mid to low level manufacturing in Thailand. Thailand has housed whole supply chains in the auto sector, for example, through their relationship with the Japan automakers since the early 1970s. So they've got a strong record on that particular space. Malaysia is benefiting from some of the shifts in the IT sector, Singapore to some degree, in mid-level manufacturing, Indonesia to a minor degree. The big winners will be Vietnam, Thailand, Cambodia. And Thailand's investment in the Eastern Economic Corridor project, providing logistics around the industrial parks in that region, will help the scalability of those supply chains being housed there. So China's dealing with this in a number of ways, trying to offset some of these structural factors through structural supply side reform, right? So improving efficiencies by reducing capacity in inefficient industries like steel, for example. State-owned enterprise reform, Belt and Road. And also investment in special technologies, such as artificial intelligence, big data, etc., to try to improve what economists call total factor productivity. Now, the problem with the Chinese economy is that their investment share of their economy is 50%.
Okay.
That's almost the highest in the world. Now, when I teach my students about diminishing returns to capital, so once you've already got a large amount of capital in your economy, incremental increases in capital give you very little bang for your buck in terms of economic growth. Contrast being North Korea, who have very little foreign direct investment. A little bit of capital there goes a long way, leads to high levels of growth, not so much in China. So for them, the way in which they need to offset some of these structural issues is through those investments in special technology and innovation to improve that total factor productivity.
We talked about the winners in ASEAN. I do want to ask you about India, because people tell me that India should be a recipient and should be getting benefit from all of this, but it's just so complicated and difficult to do business there that they're not getting it.
India's not a beneficiary of deglobalization because they're not a manufacturing hub.
Ah, okay.
So it's very much a domestic demand-oriented economy. Now that has its benefits because they're not exposed directly to any trade wars. So their tradable goods component of their economy is relatively small. They have net exports, but they're largely in services, particularly IT services. India requires foreign direct investment. Yeah. So in the case of India, the risk for them is in the current environment is a stronger US dollar, possibly as a consequence of stimulatory policy in the United States. Then with India's dollar-denominated debt being more difficult to service, leading to higher sovereign debt spreads and weakness in the currency. We're seeing a bit of that recently. Not a lot, but a bit of it. But structurally, the Indian economy over the long run is benefiting from a demographic dividend. They're unlike China, unlike Japan, unlike most of the West, that aging society which is leading to a reduction in the labour force participation rate, i.e. the percentage of the population between 16 and 60 is falling. So a fewer number of people need to support the people in the tails, either the young or the old. Their labour force participation rate will increase over the course of the next 10 to 15 years. One of the few countries in the world. Another one in the region is Indonesia. And so that will be a growth dividend or demographic dividend for them. And that their domestic growth-oriented policies, in the context of even a protracted trade war or lack of free trade regime, even if different scenarios transpire after the presidential elections in the United States this November take place, put them in a reasonably good place. But the near-term risks for India will be their sovereign cost of capital going up as a consequence. Like all emerging markets that have dollar-denominated debt, that may suffer in a stronger dollar environment.
So I want to end this. We've gone through Asia. Thank you very much. I just want to end with your views on, just briefly, the US and the EU this year and how that will impact Asia. Yes. So I think in the European economy has its problems, obviously. It has its own unique set of problems. The US, thankfully, do not have large financial systemic risk problems, as they did in the lead up to the global financial crisis. Right. So excesses in the mortgage-backed securities market and so on. The banking system is much better reserved now than it was 10 years ago. So you don't have those financial sector. There are pockets of risk, such as in shale oil, right. Leveraged loans, but they're not large relative to the economy. Whereas in Europe, the banking system is in far worse shape, particularly in Italy. The Italian banks are not as well positioned. So there are some concerns there. There are concerns, as there always are in the context of the European Union, where you've got monetary union, where monetary policy is determined by a centralized monetary authority, the ECB. But then the separate countries decide on their own fiscal policy. Right. So coordination problems there will be an issue. The other thing is that with Brexit still yet to play out, and still the possibility of a no-deal Brexit, which is a lose-lose for both the UK and the Eurozone respectively, is a potential growth shock, negative shock as well. So this is not a favourable external environment for the rest of the world, including the United States. Great. So, Paul, this is the point, and we always like to bring a point in our conversations to our viewers. What is the one point about Asian economies or Hong Kong? What is the main point we should take away? The main point is that this year is going to be a tough one. There's very little to get away from that. I think the policy response by the authorities has been sound. We're likely to see the benefit of that in the second half of next year. Now, whether we then head off into a more sound recovery path in 2021, 2022 will depend on
vaccine, no vaccine, will depend on second wave, no second wave, which is yet to play out.
Great. Thank you very much, Paul.
My pleasure.
That's it for this episode of The Point. Continue the dialogue with us on Facebook, LinkedIn, and Twitter, and we'll see you next time. Bye for now.